Iranian drone debris hit the side of the Burj Al Arab on the last day of February 2026. The fire was contained within minutes. Several weeks later, Jumeirah began an 18-month renovation, and Dubai's most photographed hotel went dark. In the same quarter, Gulf sovereign wealth funds deployed $25 billion in new investments. A war was happening above the buildings. Beneath them, capital was moving faster than at any point in the last 5 years. The system was finalized in 1976. Now we find out what it was actually built to do. The structure people are watching right now was designed in response to a different war. October 1973, the oil embargo. Prices rose 4 times in 3 months, and for the first time, the Gulf states held real leverage over Western economies. They also held something they had never managed before: surplus capital at a scale no banking system in the region could absorb. 6 Gulf states today manage roughly $5 trillion through 11 sovereign wealth funds. $2 trillion of that is invested inside the United States alone. Sheikh Zayed bin Sultan Al Nahyan, the founding ruler of the United Arab Emirates, did this because he had read the historical record of what happens to oil states that spend instead of invest. Venezuela had done that. Iran had done that. The pattern was visible by 1974. In 1976, Abu Dhabi created ADIA, the Abu Dhabi Investment Authority, and gave it one mandate: convert oil into capital before the oil runs out. But the public record only shows half the picture. On February 28, 2026, Iran launched a coordinated strike on the UAE. Over 2 days, 137 missiles and 209 drones targeted the country, and UAE air defenses intercepted the overwhelming majority of them. Debris hit Dubai International Airport, started a fire at Jebel Ali Port, and struck the Fairmont on Palm Jumeirah. Later that night, fragments from one intercepted drone fell on the outer facade of the Burj Al Arab and started a small fire. Civil defense had it under control within minutes. The hotel kept operating. The damage was minor by every official measure. For a country absorbing one of the largest drone and missile salvos in the region's history, that outcome was not an accident. It was the result of years of defense investment. The market response was not minor. Tourism collapsed first. Occupancy rates at Dubai hotels had been running at 85% through January and February. By the week ending March 14th, occupancy was down to 22.8%. That was the lowest reading since April 2020, the peak of the pandemic. But that was the public number. The private response was different. 6 weeks after the strike, Jumeirah Group announced that the Burj Al Arab would close for 18 months of full renovation. On April 1st, the Armani Hotel inside the Burj Khalifa closed for a complete refurbishment. By mid-April, the St. Regis on the Palm had started refurbishing rooms, and the Atlantis had paused 3 of its signature restaurants. A senior executive at Dubai Holding, the parent company of Jumeirah, told a French trade publication exactly what the logic was. The quote translates as, "Use the capex, do the renovations now." The hotels closed not because they had to. They closed because the timing was perfect. This is the first move in the playbook. Buy assets or upgrade them, while everyone else is panicking about the building next door. But the hotels are the visible part of the story. The invisible part is happening 60 kilometers away. The Abu Dhabi crude oil pipeline was built between 2008 and 2012. It runs 360 kilometers across the UAE from oil fields near Habshan to the port of Fujairah on the Gulf of Oman. It was designed for one purpose: to export oil without passing through the Strait of Hormuz in case Iran ever tried to close it. The West-East Pipeline has been under construction since March 2025, built by a Chinese engineering consortium under a contract signed in September 2024. On May 15, 2026, Abu Dhabi Crown Prince Sheikh Khaled bin Mohammed bin Zayed directed ADNOC to accelerate the project. The pipeline will double export capacity through Fujairah and is scheduled to come online in 2027. The first pipeline was built in case Iran ever closed the strait. Iran closed the strait. The pipeline worked, so they accelerated the second one. But that is not the most significant energy decision the UAE made this quarter. On April 28, 2026, the UAE announced its withdrawal from OPEC, effective May 1st. The UAE had been a member since 1967, before the country itself was founded. It was OPEC's third largest producer behind Saudi Arabia and Iraq. The UAE has committed $145 billion to expanding upstream oil capacity to 5 million barrels per day by 2027. OPEC quotas were a ceiling. The war removed the ceiling politically, the exit removed it permanently. But oil is only half the architecture. Here's the other half. The same first week of March 2026, drone debris damaged an Amazon data center facility in Dubai. The damage was localized. The construction next door did not stop. In Abu Dhabi, work continued on Stargate UAE, the largest AI infrastructure project ever announced outside of the United States. The campus is designed for 5 gigawatts of total capacity. The first 200 megawatt phase is scheduled to come online in 2026. The build is being delivered by G42 in partnership with OpenAI, NVIDIA, Oracle, Cisco, and SoftBank. Between 2023 and 2029, Microsoft is committing $15.2 billion to the UAE. $7.3 billion was already spent by the end of 2025. The remaining $7.9 billion is being deployed between 2026 and 2029, directed almost entirely at AI and cloud infrastructure. Silicon Valley raises capital. Abu Dhabi pours concrete. Only one of those two activities continues during a war. The pattern is older than the data center. In August 1990, Iraq invaded Kuwait. Saddam Hussein's forces froze every state asset they could reach. The Kuwait Investment Office in London, the European arm of KIA, kept operating uninterrupted. From a building in St. James's Square, KYO functioned as the finance ministry for the Kuwaiti government in exile, paying salaries, servicing debt, and funding the liberation effort from accounts that Baghdad could not touch. That was not luck, it was the architecture. And in 2026, every major Gulf state is running a version of the same system. Kuwait built it first. Abu Dhabi scaled it, and to the west, a different sovereign is now making the most consequential pivot of the war. That pivot looks like this. The Hexagon data center development at King Abdullah Economic City represents a $2.7 billion commitment to build a 480 megawatt hyperscale facility. NVIDIA and Humane, the new sovereign AI company backed by the Public Investment Fund, announced a $10 billion partnership to develop data centers across the kingdom. DataVolt signed a $5 billion agreement to build a 1.5 gigawatt facility inside NEOM's Oxagon Industrial Zone. Saudi Minister of Economy and Planning Faisal Al-Ibrahim said publicly in early 2026, "We are reprioritizing towards sectors that need it the most, and today it is technology, artificial intelligence." That sentence is the public version of a private decision. In April 2026, PIF released its new 5-year plan. The flagship element is a $925 billion domestic fund focused on Saudi industrial and technological capacity. Money that 2 years ago was earmarked for NEOM, the megacity, is now being routed toward NEOM, the AI campus. The Western press is reading this as a retreat. The deal flow tells a different story. The Gulf is not pulling out of US technology. The Gulf is doubling down, because the only buyer in the world with both the capital scale and the political mandate to fund AI infrastructure right now is the Gulf itself. The data centers do not stop because of a war. The data centers go up faster because of a war. War makes the strategic case unanswerable. Global SWF, the institution that tracks sovereign wealth fund activity in real time, published its Q1 2026 report in April. Mubadala, PIF, and Qatar Investment Authority together deployed close to $25 billion of new capital between January and March of 2026. Roughly a third of that quarter was inside the active war window. The same quarter, Mubadala closed its third Brazil fund, exceeding its initial target of $750 million to raise $900 million. On May 11th, the Geo IPO in India was restructured. ADIA committed approximately $750 million. Mubadala and PIF combined for roughly $1.5 billion. The new structure routed the proceeds to the company instead of to the selling shareholders. The Gulf funds were not taking an exit. They were holding for the long term. But the clearest signal did not come from what they bought. It came from what they cut. PIF ended its multi-year partnership with the Metropolitan Opera in New York. Saudi Arabia paused LIV golf expansion outside the United States. Several entertainment and image-building partnerships were quietly wound down through Q1 and Q2. They cut the opera. They kept the data centers. Priorities became visible. The same pattern shows up across every collapse on record. Argentina, 2001. Lebanon, 2019. Greece, 2010. In each case, families and institutions without this kind of structure fragmented within months. Capital fled in disorganized waves, asset prices collapsed, and what remained got bought at the bottom by people who had built exactly the kind of system the Gulf finished assembling in the 1990s. Different countries, identical machinery. But the loudest signal of the entire quarter did not come from the funds themselves. It came from the people lending them money. In March 2026, with active hostilities still in progress, the UAE issued sovereign debt. The market not only absorbed the issue, it oversubscribed it. The bonds priced at 16 basis points over comparable US Treasuries. For context, that spread is tighter than the cost of borrowing for several European governments operating in peacetime. A country at war borrowed money cheaper than most countries at peace. The bond market is not sentimental. The bond market is also not stupid. The buyers of those bonds are looking at the same balance sheet that built ADIA in 1976 and KIA in 1953. The reserves are real. The investment track record is real. The political stability inside the UAE is real. The drones are an external risk, not a structural one. The market priced that distinction at exactly 16 basis points. Wall Street priced the war at 16 basis points. That is what 50 years of architecture buys you. The same week, the UAE was selling debt at near US Treasury spreads. JP Morgan revised its UAE growth forecast down by 2.3 percentage points. The two facts are not contradictory. They are both true at the same time. Short-term growth is hit by the war. Long-term creditworthiness is unchanged. The market reads it that way because the market has watched this exact structure absorb shocks for 50 years. But the bond market reading still leaves one question open. Who actually benefits when this structure does its job? In April 2026, Semaphore ran a piece on Gulf capital flows during the conflict. The reporter asked the question every Western analyst had been asking: will the Gulf redirect billions of dollars away from American AI companies in retaliation for the war? The answer, from a senior figure inside one of the funds, was the single most revealing sentence of the entire quarter. Gulf investors are not going to redirect tens of billions of dollars into OpenAI and Anthropic competitors outside the United States because they do not exist. This detail looks minor. It isn't. The system Sheikh Zayed designed in 1976 was built so the Gulf would never again depend on a single Western buyer for its oil. 50 years later, that same system has produced an outcome the original designers did not anticipate. The Gulf funds are now the indispensable buyer for the most strategically important industry the West is building. ADIA, Mubadala, PIF, and QIA collectively account for the kind of patient capital that American AI infrastructure cannot raise from anywhere else at this scale and at this speed. The 1976 structure did this because oil ends, and the capital that replaces it has to live somewhere. In 2026, it lives in the only place where the next decade of compute is being built. The roles have inverted. The dependency has not. The Burj Al Arab will reopen in late 2027. Stargate UAE Phase 1 comes online before the end of 2026. The West-East Pipeline delivers its first barrels in 2027. What you are watching in the Gulf right now is what it looks like when a sovereign wealth structure does the job it was designed for. Mellon did this in 1929. KIA did this in 1990. ADIA, PIF, and Mubadala are doing it now. The hotels close. The pipelines get built. The data centers rise. The bonds get bought. The capital keeps moving. When the war ends, the capital will still be here. It already is. The system was finalized in 1976. In 2026, you are seeing what it was built to do. Next on Wealth Cipher, 400 years before the Rockefellers built their first bank, a Dutch dynasty figured out that power does not need a throne, it needs a balance sheet. That is the video. Subscribe. The Cipher has always existed. Now you know where to look.